Okay, M1212 states for each of the following independent cases, compute cash flows from operating activities using the direct method. Assume the list below includes all relevant items for operating activities. All right, with the direct method, it's different than the indirect method. It identifies separately line items on the income statement. It takes these line items and it calculates what the cash flow is from each individual line item and what other accounts, like balance sheet accounts, that might affect those line items, okay? Whereas the indirect method starts with net income, which is an aggregated number, rather than the individual line items. It starts with net income and then backs into what the cash flow is from operating activities. So this takes individual line items and tries to calculate the cash flow from each individual line item. There's three main groupings that we need to know. The groupings are the cash collected from customers, the cash payments to the inventory suppliers, and the cash paid to the employees and the service suppliers. These are the three main groupings, and here's how you get there. For the cash collected from customers, our starting point is sales. From sales, we adjust for accounts receivable. If accounts receivable goes down, we add it to sales. And if it goes up, we subtract it from sales, going the opposite direction. Now, this should sound pretty familiar because it's similar to what we did with the indirect method. But remember that our starting point is sales. And remember also that we're trying to calculate cash collected, okay? And these other groupings, we're calculating cash paid, okay? Cash paid instead of cash collected. So keep that in mind because that'll affect your whole rationale when you think about the additions and the subtractions, the way they work. But this is cash receipts. That's what we're looking for here. So then let's look at why these adjustments make sense, right? If our starting point is sales and accounts receivable goes up, we subtract that increase. Why? We didn't actually get cash. What's our goal? Cash collected from customers. If accounts receivable goes up, that means we didn't get cash. We credited sales revenue and debited accounts receivable, but we didn't receive cash, right? So we subtract it. And the opposite is true. If accounts receivable goes down, that means we got cash, so we debited cash, credited accounts receivable, but we didn't do anything with actual sales revenue, which is our starting point, right? So that's the rationale for those adjustments, and those are pretty familiar because they're similar at least to what the indirect method was. The next one, the cash payment to inventory suppliers. Our starting point here is cost of goods sold. I want to make this real clear. This is cost of goods sold. And I know I'm kind of slowing out the way I'm saying that, but it has to be clear to you that this is the cost of the inventory you actually sold, not the cost of inventory altogether. It's a totally different number. Remember that when we buy inventory, we defer that cost. How do we defer it? We place that cost on the balance sheet as an asset. And we wait until we sell that asset, recognizing the revenue when we sell it, and then we match the cost, we match the expense. Sounding familiar? Matching principle? We match the expense with that revenue through cost of goods sold. Okay? So this represents just the inventory we sold, not all inventory. And that's important because our goal here is to calculate cash payment to inventory suppliers, not the cash payment for the inventory we sold. Does that make sense? So our starting point is this. We obviously then adjust for inventory. If inventory goes up, then we add that amount that goes up to cost of goods sold. Why? Our goal is to calculate cash payment to inventory suppliers. If there's inventory that's increased, it means we bought inventory, we just haven't sold it yet, right? So we still had to pay our suppliers, therefore it would be part of the cash payments to suppliers. But it's a bit of a fallacy in the sense that we are assuming all inventory was bought with cash, and that's not necessarily true. Sometimes we can buy inventory on an account, hence the second adjustment. The second adjustment is accounts payable. If accounts payable decreases, then we add this amount to cost of goods sold, and if it increases, we do the opposite, we subtract it. Why? Well, if accounts payable decreases, that means we debited accounts payable and credited cash. Those two transactions, those two journal entry line items there, they don't show up in cost of goods sold, but cash has decreased, meaning we had a cash payment. Therefore, we need to adjust our starting point to get to cash payment to inventory suppliers. So that's the rationale for that part. Next is SG&A expenses. These are a starting point for cash paid to employees and service suppliers. In this instance, SG&A expenses are all the other individual expense items that shown up on the income statement. Remember, line by line is what the direct method is trying to do, is trying to adjust each individual section for what its change in cash is, okay? So, starting point, we'll take a random expense that we might have. If we have a prepaid related to that expense that is increased, right, then we add that amount to the expense. Why? What's the rationale? Well, if we have a prepaid, that means we debited a prepaid expense, which is an asset, and we credited what? Cash. but neither of these items are in the expense category, right? A prepaid expense is an asset. Therefore, since there was a cash payment, right, because we credited cash when we bought that prepaid, right, we have to add that amount to SG&A expenses. And the same is true on the opposite side. If we used up a prepaid, we debited an expense account like rent expense, credited prepaid rent, right, but where was the cash? So there's an expense account that's increasing, but no cash being used. Therefore, we subtract that amount. And then on the last one, the last adjustment that we'll talk about is accrued liabilities. Remember accrued liabilities we talked about in chapter 4. Those are liabilities that we either will never receive an invoice for or haven't yet received an invoice, and oftentimes they include things like estimates. If accrued liabilities decrease, we add that back. Why? Same rationale when we're talking about accounts payable. Our goal is to get to cash paid, right? If accrued liabilities, which is a liability, goes down, that means that we've paid cash, right? We've paid for it. Therefore, we want to add that amount back to the expense. Why? Well, the journal entry was debit the liability to decrease it, the accrued liability, credit cash. But there was nowhere where it showed up as an expense. Therefore, we need to adjust our starting point to get back to cash pay. All right, so with this in mind, let's use all this information to solve for case A. B and C is written up here. Again, I think those are great problems for you to try on your own. It's the exact same formula as what we just talked about here and what I'll just now show you in A. All right, so A says, we start with sales revenue of $50,000, and that's good. That's our starting point for what we want for cash receipts or the cash collected from customers. So we'll start here with $50,000, but we then have to adjust for accounts receivable. So accounts receivable in this problem go down by 1,000. So if accounts receivable go down, we're going to add that back. We can see that formula right over there. That means that our cash collected from customers is going to be 51 as our first grouping. Next is cost of goods sold as our next starting point. That's 35,000. We then need to adjust for inventory and accounts payable. Accounts payable doesn't have anything. There's no change there, so that would be 0. Inventory increases by 2,000. If we look over in our formulas over here, if inventory increases, we add that. So we'll add the 2,000 here. Leaves us with 37 as cash payments. So notice I'm putting brackets around this. Why? This is cash payments. It's not cash receipts. Let's go on to the next one. The next starting point is going to be other operating expenses. And notice I skipped right over depreciation expense. Why? Depreciation expense is not used for the direct method. For the indirect method, it is used. We add that back to net income. But for the direct method, we can just skip over it. So other operating expenses would be part of SG&A expenses. That would be our next starting point. 5,000 will be where we start at. And then we have to adjust for any prepaids and accrued liabilities. Well, they don't give us any information about prepaids. They do give us some information about accrued liabilities. They say accrued liabilities has increased by 1,500. If there's an increase in accrued liabilities, we see that we subtract it. So we'll take 5,000, subtract out the 1.5. We're left with 3.5 as a reduction because this is cash paid. And if we add these totals up, we get net cash flow from operating activities to be 10.5. Okay? All right. If you have any questions about this, again, the direct method, it's the preferred method by FASB. Why? It gives you more detail as to what's happened, but 99% of the companies use the indirect method right now at the current time that we're in. So indirect method is going to be the method I test you with, but this is still a great method of practice in case you experience it in either practice out in the field when you get into the workplace, or perhaps if you experience it in another class. If you have any questions for me on M12, please let me know.